Hi everyone, if you've been following me long enough, you know that I'm a big fan of index funds, and that's primarily what we use in our client portfolios. But what is an index fund? Before we define an index fund, we need to first define what is a stock index. And a stock index is a measure of how the overall health of a sector of the economy is doing or a sector of the market is doing. Most people are familiar with the Dow Jones Industrial Average because it's very widely used in the news. But in 1896, Charles Dow and Edward Jones, they wanted to get a gauge of how the overall health of the economy was doing at that time. And what they decided was they were going to take the top 30 companies of that time, the top 30 companies, and then take the closing prices of those 30 companies at the end of the day, the stock prices, and then they were going to add them up and they were going to divide it by 30. And that was going to give them a measure of how that health of the economy was doing at that time. And they would track that index on a day-to-day basis to see if the economy was doing better, if it was doing worse. And what they essentially created was the Dow Jones Industrial Average that we continue to use today, well over 125 years later. It's important to note that the Dow Jones Industrial Average that was created by Charles Dow and Edward Jones isn't actually a hypothetical index. It's a paper index because they didn't actually buy the stocks that are in the index. They just wrote it down on a piece of paper, summed it up, and divided it by 30. It was not until many years later that the index fund, which we'll describe later on, it was many years later until the index fund was created that allowed investors to invest in that particular stock index. Stock indexes are important for two primary reasons. One is they're an economic leading indicator. What that means is the stock market and a stock price is what the investor's expected view is going to be of that stock earnings in the future. It doesn't matter what happened to the stock in the past and how much it's earned. A stock price today is what investors expect that company to earn in the future. So because it's what they expect that company to earn in the future, it's a leading economic indicator, meaning that it's a good indicator of what the economy is expected to do, usually 6 to 9 months out. Another reason why a stock index is important is because it's used as a benchmark. And it's used as a benchmark for usually a fund manager that wants to see how they're performing relative to the overall market. So for example, if you had a fund manager that was investing in large US companies and they were a stock picker and they wanted to gauge how their stock picking skills compare to the overall market, they would benchmark themselves against, for example, the Dow Jones Industrial Average. And if they did better than the Dow Jones Industrial Average, that would mean they're really good at picking stocks. But if they consistently underperformed the Dow Jones Industrial Average, that means they were lousy at picking stocks. Hey, if you like the video so far, please remember to subscribe, like, and share our video and our channel. By doing that, we're able to create more content like this and reach more audiences. Interestingly enough, the Dow Jones Industrial Average is not considered a good index because it represents only 30 stocks, even to this day, over 125 years later. And the reason why it's not considered a good index is because it's a very narrow part of the market. 30 stocks is not a good representation of over 12,000 stocks that exist on the US stock exchanges. So for that reason, the Dow Jones Industrial Average, while still quoted on a day-to-day basis, is not really considered a good index. But the reason why we still view it and quote it and track it is because the Dow Jones has gone through so many economic cycles that there's a lot of data points that we can go back and look to see how the economy performed given certain events that have happened in the world. We can go back and look to see how the market performed during the Great Depression, the Great Recession, during World War I, World War II, Vietnam. All these different times of our history, we can see how the market performed. And that's the reason why the Dow Jones Industrial Average has this rich history, because it's got a lot of data points that we can go back and analyze. Every country has its own index. We talked about the Dow Jones Industrial Average, but the Dow is not the only index in the United States. In the US, we also have the S&P 500, which is very, very widely used, and it's also very widely known. The S&P 500 are the top 500 companies in the United States, which is a much more broader index than the Dow Jones Industrial Average. Another widely referenced index is the NASDAQ. Now, the NASDAQ represents primarily non-financial stocks, and usually technology stocks are composed of the NASDAQ. And the NASDAQ is another index that's used in the US. And NASDAQ actually has two components. There's a NASDAQ composite and the NASDAQ 100. And the NASDAQ 100 is usually the really tech-focused top 100 non-financial companies. Another major index in the US is the Russell 2000. The Russell 2000 is an index that tracks US small companies. On the international front, in Europe, we have what's called the Financial Times Stock Index, also known as a FTSE. And the FTSE tracks 100 of the largest companies in the UK. In Germany, there's a DAX. The DAX is the equivalent of their major index, and that represents 40 of the largest companies in Germany. In France, the France index is known as the CAC 40, and obviously it's got 40 stocks that represent the largest companies in France. In Japan, you have the Nikkei, and it's a Nikkei 225, and that's 225 stocks in the Nikkei stock or the Japanese stock exchange. And then lastly, you have the Australian All Ordinaries that represents the Australian stock index. Now, I just gave examples of the developed countries. There are a lot of other indexes in many different countries, but these are the top ones in the more developed countries. So now that we understand what a stock index is, now let's pivot towards what is a stock index fund. An index fund is an investment vehicle that allows investors to invest in a stock index. And that vehicle could be in a couple of different forms. That investment vehicle could either be a mutual fund or it could be an exchange traded fund. So the index fund is actually a vehicle that allows investors to invest in that index fund. And interestingly enough, the first index fund was created by Wells Fargo in 1971 that tracks the S&P 500. So well after the first index was created, the index fund was created in 1971 by Wells Fargo. And the idea of the index fund, the purpose of it, whether if it's in the form of a mutual fund or an exchange traded fund, is to track or mimic that index, that underlying index. So for example, if you have an index fund that is tracking the Dow Jones Industrial Average, that index fund is going to mirror the performance of the Dow Jones Industrial Average. That's the objective of that index fund, to mirror the performance of the underlying index. One of the most popular indexes in the world practically is the S&P 500 because it's very widely known. It's a very, very broad index. And also there's many different companies that create index funds that allow investors to invest in the S&P 500 at minimal cost and have a very, very broad-based exposure. So the S&P 500 is a very widely used and widely created index fund for investors to invest in. So now that we know what a stock index is and we know what an index fund is, let's define what is the difference between a mutual fund and an exchange traded fund. A mutual fund is a pooled investment. It's when a fund manager collects money from many different investors and then it uses that pooled money to invest in a particular investment objective. Not usually, but it could be anything. It could be US large companies, small companies, international, whatever the objective is. And the first mutual fund was actually created in 1924, many years ago. And the benefit of the mutual fund is it allowed people to get immediate diversification. With a small amount of money, they could invest in a mutual fund, and that mutual fund with its pooled assets was able to buy many different stocks or bonds and then get immediate diversification from that. An exchange traded fund, also known as an ETF, is an investment vehicle that holds a collection of either stocks, bonds, commodities. And the idea behind an ETF is that it usually tracks a particular index, such as the Dow Jones or the S&P 500 that we'd already talked about a little earlier. Unlike mutual funds that are only traded once per day, so a mutual fund, you're only able to transact in that mutual fund at the end of the day. An exchange traded fund, you can trade throughout the day. So that's one of the biggest benefits of an exchange traded fund, is that it's available to trade throughout the day. You can buy it in the morning, sell it in the afternoon, and then rebuy it again later in the afternoon. So it's very, very liquid, whereas a mutual fund can only be traded once at the end of the day. There's some other pros and cons between a mutual fund and an ETF, and one is not better than the other. It just really depends on what your objective is. For example, we already talked about an ETF being continuously traded throughout the day, whereas a mutual fund is only traded once a day. Another difference between an ETF and a mutual fund is an ETF usually has lower fees than a mutual fund does. Also, a ETF is more tax efficient than a mutual fund. And the reason behind that is because a mutual fund, as I said earlier, is a pooled investment. Whenever there are buys and sells that occur during the year in a mutual fund, there could be taxable events that happen in that fund. And that taxable event has to get pushed down to each of those investors that own the mutual fund. And by doing that, it creates a taxable event when the fund owner, the investor, didn't even do anything. For example, if a mutual fund during the year had sold a stock and had a large capital gain, and you're an investor in that mutual fund, but you didn't sell your mutual fund. Well, at the end of the year, you're going to get a statement that says you had a capital gain distribution and you have to pay tax on that, even though you didn't sell your mutual fund. This is actually a big disadvantage of a mutual fund, which is why a lot of people are migrating towards exchange traded funds that don't have that capital gains distribution, which makes them much more tax efficient than a mutual fund. Another benefit of an ETF versus a mutual fund is that a ETF, you can do options trading on them. Most ETFs that are very widely traded have options capabilities, but you can't do that with a mutual fund. So if you wanted to buy an options contract, or you want to take a derivative bet on a sector or an exchange, you can do that with an ETF, but you can't do that with a mutual fund. It's important to note that not all index funds are created equal. It depends on how they are constructed. An index fund can be constructed either as a full replication, it could be optimized, or it could be by sampling. Ideally, what you want is an index fund that's full replication. What that means is the index fund that you're buying that's tracking or mirroring a particular index, let's assume it's the S&P 500. If that index fund is doing sampling, that means that index fund is not buying all those 500 stocks in the S&P 500. They're sampling to see which ones they want to buy and which ones they're going to include in that fund that you're buying. What you want with larger funds, when this occurs, what you want is full replication. So if you're buying that index fund and that index fund is also buying that index, the S&P 500, you want to fully replicate the stocks that are in the S&P 500. That way, you're going to have pure exposure to the S&P 500, and you're not going to have any deviations from what your fund performs or what the S&P 500 performs. It'll be a very close match with performance. Now let's talk about how to go about choosing an index fund, whether if it's a mutual fund or an exchange traded fund. Although I'm going to lean a little bit more towards an exchange traded fund. What you want is you want a fund that is very highly liquid. And the way you can define that is when it has a high average volume of trading per day. So if you're selecting an ETF, you want to look at the average daily volume. And usually if it's over 1 million shares or 2 million shares, the higher the better. That means that on any given day, you could easily transact that ETF without any problems at all. If you have an ETF that's got very, very low volume, it's going to make it difficult for you to buy and sell that ETF, especially if you're trying to trade a large amount. So you want something that's got very high volume, and that creates what's called liquidity. Another factor you want to look at is you want to see that an index mutual fund or an index fund has low fees. Whether if it's a mutual fund or an exchange traded fund, you want to make sure it has low fees. The idea behind that is because an index fund is not doing any stock picking. There's no one behind the curtain identifying what stock is going to outperform and what stock's going to underperform. They're not doing any of that. all they're doing is buying the underlying index. So for example, if an index fund is tracking the S&P 500, all they're going to do is buy the stocks in the S&P 500. That's assuming they're doing full replication. They're just going to buy the stocks in the S&P 500. Now, they might have some minor fees associated with it, which is why you want to look for a fund that's got low fees, but they're not picking any stocks. So it's very, very low cost. They're just mimicking and mirroring the underlying index. Another thing you want to look for is a true asset class exposure. What that means is if you're buying, whether if it's a mutual fund or an exchange traded fund, you want something that's going to stick to its objective. If you buy an S&P 500 fund, for example, you don't want that fund to one day decide they're going to go into the Russell 2000, maybe some small companies, maybe they might buy some international companies. That's going to create style drift for you. It's going to be drifting out of your original objective. You want it to stay true to its objective and focus on what the fund index is tracking. So that's very important for you to take into consideration. Another thing to look for when you're trying to buy an index fund is you want full replication. As I mentioned earlier, an index fund can either be created by full replication, by sampling, or optimization. Only full replication gives you true exposure to the entire index, whereas the other two methods don't give you a true exposure. They only give you a partial exposure to it that's supposed to be optimized and mimic what that underlying index is. Okay, so by now you know what an index fund is. Now the next step is, how do you actually buy an index fund? Well, you first have to create an account at one of the large brokerage houses. You either have to create it at Charles Schwab, Fidelity, Interactive Brokers, E-Trade. There's a lot of them out there. And once you've opened up your account, you deposit money into that account. And once you deposit money, you're able to buy an index fund, whether if it's an exchange traded fund or a mutual fund. And there are tons of index funds out there, both exchange traded and mutual funds. So you'll have to do a little research and see which one is a more appropriate fund for you. But the steps in actually buying an index fund are first to open up the account at one of those brokerage houses, deposit the money, and then go ahead and buy that fund. Hopefully you found this video interesting. Please remember to subscribe, like, and share our channel, and I look forward to seeing you on our next video.